Hello friends, this is Professor Amarjeet Kaur. I am teaching at Gurugram University in the Department of Management. My area of teaching is primarily accounting and finance. I have been working from last 33 years and it's my privilege that I am here with you to talk about cost of capital, which is a very important topic in capital, in financial management, the series we are running with. So, the background if we talk about of this topic goes back to the first session we had in this regard, where we talked about financial decisions. So, in financial management we have three primarily financial decisions, which is investing, financing and dividend, right. So, these three decisions are the ones which decides about the message a company gives about its policy, about its expansion plan, about opportunities, about growth story, everything, and which in turn affects the risk and return characteristics of that company. And then finally, this message about risk and return capacity of the company actually affects the share price. Of course, there are many more factors as well, and then this share price affects the shareholders' wealth, right. So, coming back to, there are three decisions in financial management: investing, financing, dividend. They are affecting that how a company is perceived when it comes to risk and return characteristics. Then it affects the pricing of the share, and then that finally leads to affecting the shareholders' wealth. It means the shareholders' wealth, which is the objective of financial management to maximize it, can be actually received, perceived and taken that is the ultimate outcome of the financial decisions a company takes. So, in this regard, investing, which we discussed couple of weeks ago, that is about investing in long term assets, capital budgeting decisions, and investing in short term assets like working capital, current assets. So, we have talked about long term assets, that is capital budgeting, we have covered in length. And today I am going to talk about the second decision, financing, which actually addresses the concern and the question that where would I fund those assets which I decide, which I chose under capital budgeting, right. As a business, I decide to invest in a building, I decide to buy a plant, a machinery, etc., etc. That is actually affecting my balance sheet in the asset side. Whereas, the how would I fund those assets, that pertains to the liability side of the balance sheet, which is actually financing. Means I will get loan from a bank, I will raise equity share capital, I will issue debentures, I will raise term loan, I will issue debentures, etc., etc. So, all these are actually sources of finance which I am referring to. So, primarily they fall under ownership capital, that is equity capital, or they fall in debt. Then we have many innovative instruments, we have hybrid as well, primarily debt and equity, right. So, that means either we are issuing bonds or debentures, we are going for short term borrowing or long term borrowing, they all are sources of finance. Now, these sources have their own cost, each source comes with certain cost, right. Whatever the return, each of the source is expecting to get, who is giving you money, they are expecting some return in the form of some interest or in the form of some dividend. That return to them, that is their income, but to the company it is basically cost, right, cost of using that funds. So, the cost of capital is the rate of the return the company has to pay to various suppliers of funds in the company. It presents the opportunity cost for the providers of fund and guides decisions to ensure projects generate sufficient returns to cover financing cost. So, let me explain this to you. The cost of capital, as I said, is the rate of return it is expressed in terms of percentage, right? That this is the rate which company has to pay to whom? The person who has supplied the fund. You know, the supplier of funds could be a bank or an individual or an institution or a country even, right? A country borrows from other countries. Even in that case, the supplier of fund becomes the other country. So, this actually is presenting the opportunity cost for the person who has given you fund, because if I have not given you the money for your business, I would have actually used it for some other purpose, right. So, I am foregoing some opportunity to give you that money for your business, or you know, instead of depositing in the bank, I am giving you the money. Instead of depositing in an SIP plan, I am giving you the money, right. So, this is my opportunity cost. If I am the investor, if I am the retail investor, I am providing you fund. So, this is the opportunity cost for the provider of the fund, but for the company, it is the rate of return company has to earn to pay them for sure, minimum, right. So, that is how you know, the cost of capital is defined. Further, the cost of capital can be defined as a minimum rate of return that a firm must earn on its investment so that the market value per share remains unchanged. Why? Because the market price is affected by risk and return capacity, the characteristics of the company, of the firm. And this is affected by one of the decision, which is financing as well, because my returns are X amount, let's say 100 rupees per thousand I am investing, I am earning 100 rupees, means 10%, and I have borrowed money at 12%. Certainly, as a company, I am not doing good. I am spending more on the funds I acquire than I am earning. So, no way I will be perceived as a good company when it comes to return, and my share price would be adversely affected, right. So, company need to earn minimum rate of return to the extent company has obligation to pay for. Here in this example, I said company has borrowed at 12% and company is earning 10%. So, the minimum rate required for the company is 12%, that is only to break even. So, company should not be cannot sustain in long run with 12% even. Company need to earn 15-20% or even more than that to grow. So, that is how we define it as a minimum rate of return that firm must earn. It is known by many names like cutoff rate, target rate, hurdle rate, minimum required rate of return. Even for times we call it as standard rate or standard return as well. Now, any investment which does not cover the firm's cost of funds, it will reduce shareholders' wealth, as the example I have given you, because the price is going to be affected, the price of share is going to be affected by the returns company earn, and that price in turn is going to affect the shareholders' wealth. An ultimate example of the company is to maximize shareholders' wealth. Even that is the objective of the financial management, the subject we are talking about, right. So, the cost of understanding the cost of capital is very, very important for any business, as it is important to decide where to invest, where not to invest in investment decision. Likewise, it is important to decide where to procure the funds from, where not to, because we cannot afford to procure funds from a source which is higher than my expected rate of return. The cost of acquiring the funds should always be less than what I am expecting to gain from that project for which the funding is being received. Okay. So, the cost of capital can be understood from investors' point of view, from company's point of view, from different point of views. From investors' point of view, the person who is giving money to the company, the investor invested in a company's share amount, let us say rupees 4 lakh, instead of investing in a bank at a rate of 8%. So, he has sacrificed 8% for not having invested in a bank. This is how we define cost of capital from investor's point of view. So, my cost of capital is 8% because that is the opportunity cost for me. I have foregone the assured interest from a bank which is 8%, right, and I have given you 4 lakhs as a company, either through equity, either through preference share, bonds, debentures, any form I have given you in, like that is the financial instrument. But my return expected, minimum expected return is 8%, so that my opportunity cost is met. So, this is how investor looks at the cost of capital. How does company or firm looks at the cost of capital? A firm raised, let us say, 12 crore through issue of 10% debentures. For justifying this issue, a minimum rate of return it has to earn is 10%, because otherwise company will not be able to pay even to the interest to the debenture holder. To serve the debt, company must be earning 10% or more, cannot afford to earn less than this on this 12 crore which it raised, right. This is the utilization from company's point of view, and ensuring that company's capital investment decision was correct, which was taken in the investing decision under category of investing. Now, from capital expenditure point of view, because we are investing and we are making a capital expenditure. So, from that point of view, we discount. If you were with me in the previous sessions where we have spent a couple of sessions on capital expenditure, which is capital budgeting, we talked about discount rate, right. So, the discount rate is actually nothing but the minimum required rate of return only, or it can be called as a hurdle rate on the investment which we have committed. So, this discount rate for example in IRR, internal rate of return method, if it equates the inflows with the outflows. So, whatever company is spending on the project and whatever the cash flows we are getting from that project, it equates at IRR. So, anything which is earned higher than that is actually going to be in company's gains, in company's benefit. So, from capital expenditure point of view, it is discount rate equivalent to the cost of capital. So, basic aspect of cost of capital is, if you want to understand, there are 3 important things. One is the business risk and the financial risk. Number 2 is explicit cost and implicit cost. And then the third is cost of capital, which comprises riskless cost, business risk premium and financial risk premium. So, overall cost of capital is KO is R plus B plus F. This is mathematically how we define cost of capital. So, let me explain it to you. Business risk and financial risk, there are 2 types of risk any business would have. Business risk is being not able to sustain the operations, and financial risk is being not able to serve the financial obligation, which is, for example, if I am using debt to not being able to pay interest, that is my financial risk, that I am not earning enough to serve my debt, right. So, that is a financial risk. Business risk is not being able to run the operations, you do not have enough money to run the business. So, that is even higher than the financial risk. So, both risks are there, both have their own cost. Then there is another term which we use, explicit cost, the cost which is known to the business and to the investor, that what they are getting as a return, and the company knows that this is what I am going to pay. So, explicit cost, for example, if it says 8% debentures, so this 8% is explicit cost which is mentioned on the face of the instrument, but implied cost, implicit cost is the opportunity cost, which is actually not mentioned on the instrument, but it is implied that my actual cost could be less or more. My implied cost is basically the opportunity cost, which whatever I forego, it could be higher than the explicit cost, it could be lower than that, right. And this total cost of capital comprises the riskless cost and then business risk premium, which is been expected out by the investors who are giving you funds for the risk they are taking, because there is some business risk that business may not be able to operate to the level it is projecting, to operate at. So business risk, for that the investor is expecting some return, and then some premium for the financial risk as well. So that is how we have risk free cost, risk less cost, minimum, which we get from the treasury bills, from national savings certificate, which is assured by the government, right. So that is the risk, that is the R is risk less cost or risk free cost. That is a minimum required rate by anybody, because I know I can earn from NSC or treasury bill from government of India, government of any country, and I'm assured, I'm sure that that is an assured return to me. So that becomes R. Then we add some premium for business risk and some premium for financial risk. So that is how KO is R plus B plus F. Okay. So I hope you were able to understand that. So this overall discussion so far made it very clear that understanding the cost of capital in financial management is of utmost importance. So that is why I would now be talking about importance of cost of capital. So what is the importance of cost of capital? There are a couple of points. Number 1, investment decisions. Number 2, capital structure. Number 3, valuation. Number 4, risk management. Number 5 is basis for business decisions. So let me explain these points to you. Investment decisions. As I said, investment in long term assets, that is what we call as capital expenditure decision. There the cost of capital is the most important point because it works as discount factor. This is the rate at which we discount the cash inflows and cash outflows, we equate them, then we either calculate net present value, we calculate IRR. So all that modern techniques of evaluating capital budgeting decisions are based on cost of capital, discount rate, discount factor, right. Discount rate is nothing but the cost of capital. Then the capital structure is something which company has to decide about. Capital structure means the percentage of debt and equity in the total funding requirement of a company. Let us say if I am out of 100 rupees, I am using 40 rupees as equity and 60 as a debt. Another company may be using 60 as equity and 40 as a debt, right. So this is what the capital structure is. And why this capital structure? Because the cost of debt and cost of equity is different. Debt is relatively cheaper source because of the tax benefit, as we always say. So capital structure is affected by cost of capital. So it's very important that capital structure is actually carefully decided, planned about, and for that the cost of capital comes into picture. Valuation of company, whenever the company is valuation of anything, the cost of capital plays a very important role. So for valuation of assets, cost of capital comes into force. Then risk management, for financial risk assessment, we have to equate, we have to discount cash flows, and that is what financial risk management is. So risk management, for even risk management is not possible without considering the cost of capital. And lastly, as I said, basis for business decision. Any business decision is actually based on that how much return I would be getting on this investment as a business. Then if I am taking investment decision, I am actually deciding to invest or not basis on what is my discount rate, because my return could be 10% and the other company could have the return of 12%. My cost of capital is 8%, I am certainly going for it, but other company has cost of capital of 12%, they have higher expected return but cost of capital to them is 12%, they may not decide in favor of that proposal, right. This is how important it is. So even dividend, third decision of dividend is based on the cost of capital. If cost of capital of raising funds from outside is very high, company may decide not to distribute the dividend. So all the business decisions are actually based on the cost of capital. every expansion plan, modification plan, takeover plan, merger plans, everything has cost of capital which comes into play and and help us decide these decisions. So this was about importance of cost of capital. Now I would like to talk about what are the sources of long term finance. And so basically we have many sources of finance, and because cost of capital is not cost of one item. Cost of capital is the actually composite weighted average cost of all the sources of finance we use. So that is why I would be talking about sources of long term finance first, to understand this concept of cost of capital in depth. So the first source of long term finance is equity share. Then we have term loan from financial institutions. Then we have preferential capital, we have retained earnings, and then debentures and bonds. All these sources of long term finance have been discussed individually in the past. So, I am not going to discuss what they are. I believe you understand the equity share capital if you have looked at or if you have watched our previous videos on this. And the term loan from financial institutions is the second important source of which is used by companies. Then preferential is a kind of hybrid source which has been discussed in the past, but it has a preferential right on income and assets. So that is another. Share capital is another possible source for any company. Then retained earning is something which is not distributed, right? So which has been retained. Undistributed profits are something which have been retained to use them in any of the expansions, modifications, procurement of anything. So retained earnings belongs to owner, but may not be if they are not distributed, may be used for expansion plans. So the last item, which is debentures and bond, is a very important source. So equity, debentures, term loan, these are the 5 important sources of funds. Why I am talking about these 5 sum? Because basic aspect of cost of capital, that is a minimum benchmark return. In fact, for any company, the company must earn this much to meet up the cost of capital. The cost of capital consists of all the components which I just talked about, or all elements known as cost of specific source, right. So what are the cost of specific source? Because debt is one source and it has its own cost of raising debt, right. So debt funds means, for example, debentures. Company is issuing debentures at 8%. So it seems 8% is the cost on the face, on the instrument, but in fact the cost of debenture, if on the face of the instrument it says 8%, it will not be 8%. It will be adjusted for the tax benefit company will be getting, right. The first cost of specific source would be cost of debt, KD. We call it as KD. K is the cost and D stands for debt. Then the cost of equity share capital, we denote it by KE. K is cost of capital and E is equity. So E, E is actually referring to equity, the term equity capital. So cost of equity is that how much company pays as a dividend, but company does not pay. So how would we calculate dividend? Company has a choice to pay dividend or not to pay dividend. Company may decide to retain earning, right. So in that case, we have couple of models to calculate cost of equity, because there is no obligation. In the case of debt, there is an obligation to pay interest. It is very clear, it is very easy to calculate. But in case of equity capital, there is no fixed financial obligation on any company's end to pay dividend or not. And if yes, then how much? And if yes, then how much, with like how much growth every year? So there are so many questions which are which are not known to the investor, because the company may pay, company may not pay. So it really becomes difficult to calculate cost of equity under the conditions, because there is no promise to pay dividend on the equity. We have many models including CAP, CAPM model and many more models which we will be discussing in future sessions for sure in detail, and I will help you learn how to calculate cost of equity capital. Then cost of preferential capital is known as KP. The preferential capital has been discussed. What is the cost of raising or using funds through capital share, through share capital which is of preferential nature is cost of capital, right. The cost of capital for preferential would be known as cost of preferential capital, denoted as KP. And then we have cost of retained earning, KR. KR is basically the retained earnings which have been retained out of profits which company decided not to pay for, that is what is the cost, cost of retained earnings. Then you will think that how come there is a cost, company is not raising funds from anybody outsider, these are the profits which company has actually made and decided not to distribute, and it becomes retained earnings, right. Then how come there is a cost? So friends, nothing comes free in this world, nothing means nothing, even retained earnings. So in fact the cost of equity, which seems that there is no obligation to pay dividend, is the most expensive source of fundraising, because the business there is a business risk, there is a financial risk, both risks are being taken up by equity shareholders and return earnings also belong to them. That is why equity share and retained earnings both are actually very expensive. Retained earnings are almost equally costlier to the equity cost, because only saving is of the not paying to anybody for underwriting or issuance expenses or launch of issue. Otherwise cost of retained earning is very much close to cost of equity. So all these four costs, because you must be wondering that I showed you 5 items of specific sources and now I am talking about 4. The fifth one was the project or the term loan, which is very much like debt only, right. So that is why the cost of debt includes all kind of debt, be it debentures, bond or term loan. So this is combined in one head only, and rest of the heads have been discussed here. So in future we would be taking up individual cost of each of the source mentioned here, and we will be beginning with the cost of debt, followed by cost of equity, preference shares and retained earning. So this was a summary of that how the overall cost of capital is calculated. This was just an introduction. We will learn about specific cost in future, followed by the composite cost. So this is the time to sign off. Thank you very much.